Good day, everyone. My name is Jade Claire G. Downing from BSHM 3A, and today I'm going to discuss about the insurance law in Chapter 14. So, for the learning objectives will be enumerate items that can be insured by a tourism establishment, identify the rationale behind the concept of insurance, explain the different kinds of insurance, and identify the advantages and disadvantages of having insurance. So for the topic outline, first is definition and concept, then insurable interest in group insurance, insurable interest in property, beneficiaries, fire, marine, and third-party liability insurance, and IATA policy. So insurance is very useful for companies engaged in the tourism industry because there are many kind of risks in enterprises where investment oftentimes is quite substantial. So by way of example, an employer may subscribe to a group insurance of his employees as part of its employees benefit program. So companies utilizing building structures for the operation of their hotels, restaurants, and other tourism-related establishments may think of investing in property insurance against fire or earthquake to protect their investments. Lastly, an investment in marine insurance, the usual practice among companies engaged in the transportation of cargoes at sea, may also be worth looking at the insurance code now referred to as PD 1460. In case of the latter's deficiency, the provisions of insurance contracts are governed by the insurance law. Definition and concept. The law. A contract of insurance is an agreement whereby one undertakes for a consideration to indemnify another against loss, damage, or liability arising from an unknown or contingent event. Discussion of the law. The essential elements of an insurance contract are insurable interest, existence of risk, assumption of such risk by the insurer, said assumption being part of a general scheme to distribute actual losses among those bearing similar risk, payment of premium. The characteristics of an insurance contract are aleatory. So there is an element of risk. An aleatory contract is one where the obligations depend upon the occurrence of an uncertain event. Then contract of indemnity. There is an exchange of value for value, particularly in property insurance. Onerous. There is a valuable consideration given, or like payment of premium. Bilateral. Both parties are bound to do something. Formal. As to form, a policy is required to be issued, and the premium must be paid. The parties in an insurance contract are insurer, a person, partnership, association, or corporation duly authorized to transact an insurance business. Insured, a person with an insurable interest who stands to benefit from a policy of insurance. In its strict sense, the insured party is the owner or purchaser of the policy, even though benefit of the insurance may accrue to someone else. Then beneficiary, a person designated by the terms of the policy to receive the proceeds of the insurance policy upon the happening of the event insured against. It is the person named in an insurance policy as the one to receive proceeds or benefits accruing the re-under. Insurance contracts may refer to the following: life insurance, an insurance in human lives, and insurance pertaining thereto or connected therewith. Fire insurance, which includes loss by fire, lightning, windstorm, tornado, or earthquake, and other allied risks, when such risks are covered by extension to fire insurance policies or under separate policies. Marine insurance, a contract whereby one for consideration agrees to indemnify another for the loss or damage on a certain interest subject to marine risk by certain perils of the sea or specified casualties during a voyage or fixed period. Personal accident insurance, an insurance which provides pecuniary compensation for expenses or losses of income brought about by death or bodily injury arising from violent, external, visible, and accidental means. Insurable interest. An insurable interest is a legal or financial relationship with a person or property that justifies the issuance of an insurance policy. It exists when a person with would benefit from the preservation of the insured subject or suffer a financial loss from its damage or destruction. For property, the insurable interest must exist both at the time of the insurance contract and at the time of loss, while for the life of health insurance, it must exist only at the inception of the policy. Insurable interest in group insurance. Group insurance provides coverage for multiple individuals under a single contract, typically offered by an employer to insure employees and their families at a lower cost while also fostering goodwill and employee retention. To claim benefits, employees must meet conditions such as being actively at work and having completed a specific period of continuous employment. However, for group insurance to be valid, there must be an insurable interest between the policy holder and the insured mere friendship, as in the case of John Bartolome and Noel Lim, does not establish such interest, rendering the policy void. Insurable interest in property. In property insurance, insurable interest must exist both at the time the policy takes effect and at the time of loss. The value of this interest is measured by the extent to which the insured would suffer financial damage from the loss or damage of the property. A property insurance policy that provides more than the actual loss suffered is considered illegal and void under the law. Beneficiaries. A beneficiary is in an insurance contract must have an insurable interest in the life of or property insured for the policy to be valid and enforceable. In property insurance, this interest must exist at both the start of the policy and at the time of loss, while in life or health insurance, it must exist only at the time the policy takes effect. In group life insurance, as shown in the PMSI case, the rightful claimants to insurance proceeds are the designated beneficiaries, not the employer, who merely acts as an agent of the insurer in administering the policy. Fire, marine, and third-party liability insurance. Marine insurance. Marine insurance covers loss or damage to various types of property and interests connected with navigation, transit, or transportation, including vessels, cargo, and personal property during shipment or related processes. It also applies to liabilities arising from construction, maintenance, or use of such property, but excludes life insurance, surety bonds, and auto-related bodily injury coverage. The insurance extends to valuable items like jewels and precious metals, as well as transportation-related infrastructure such as bridges, piers, and docks. Additionally, marine protection and indemnity insurance covers legal liability for damages or expenses linked to owning or operating vessels, including injury, death, or damage to others' property. Fire insurance is a contract or indemnity that covers losses caused by fire and allied risks such as lightning, windstorm, tornado, and earthquake, provided these are specifically included in the policy. It only covers losses from the hostile fires, and compensation depends on whether the policy is open, based on actual loss, or valued based on agreed value. In the Gulf Resorts case, the insurer was only liable for earthquake damage to the two swimming pools, as premiums for earthquake shocks were paid only for those properties, highlighting that coverage depends strictly on the specific terms and premiums of the policy. Compulsory Motor Vehicle Liability Insurance. Compulsory Motor Vehicle Liability Insurance, or CMVLI, or third-party liability insurance, is required by law to cover death or bodily injury to passengers or third parties caused by motor vehicle accidents. Even without proving fault, vehicle owners must secure this insurance before registration, and victims can directly claim from the insurer, subject to documentary requirements and policy limits. In the NFA and versus GSIS case, the insurer was held liable to compensate the victims, but only up to the extent of the insurance coverage, not solidarily with the negligent driver or vehicle owner. War risk insurance. War risk insurance is an insurance covering damage caused by acts of war. It includes coverage for war, hijacking, and related perils. Insurers have intended to withdraw liability coverage for weapons or mass destructions. A subset of war risk insurance includes radioactive contamination, electromagnetic pulse devices, chemical or biological weapons. Coverage was subsequently provided at full policy limits for passenger liability but limited to a maximum of $50 million for all third-party injury and property damage. IATA policy. The IATA policy requires airlines to carry liability insurance, including war risk coverage, as protection from risks such as WMDs, although ultimate responsibility for citizen security lies with states. In the case of TKC Marketing Corporation, their insured cargo aboard MVAI Kaziema was detained by civil authorities in South Africa due to a legal dispute. Although the insurer Malayan Insurance initially denied the claim, stating civil arrests weren't covered, legal interpretation favored TKC. The court ruled that such insurance clauses should be construed strictly against the insurer, and that detention by civil authorities can fall under covered risk, allowing TKC to recover the claim. So to end this chapter with the quote, "Don't watch the clock do what it does. Keep going," by Sam Levinson. So this quote encourages perseverance and consistent effort, reminding us to keep moving forward steadily like the clock rather than worrying about time passing. So that's all for my report in this chapter. Thank you everyone, and once again I am Jade Claire G. Downing from BSHM 3A, and see you on the next chapter.